Hi, this is Ron Rowland with Money and Markets TV. Despite some recent declines, precious metals have been flying high this year. Gold hit a new record last month, and silver was trading at its highest level in more than 3 decades. As a result, the exchange-traded funds that track those commodities have been surging as well. Today, I want to discuss whether that trend can continue and how you can profit from it. The most popular ETF proxies for gold and silver bullion are the Spider Gold shares and iShares Silver. From 2007 through 2010, GLD jumped 119% and SLV surged 134%. Granted, they were extremely volatile, falling hard during the financial crisis of 2008. But the long-term trend for both ETFs was definitely bullish. This year, gold and silver have continued to rise, but this time I see a difference. GLD rose a healthy 9.8% through the first 4 months of 2011, but SLV's gain during the same period was a staggering 55.3%, more than 5 times the increase in GLD. Of course, it's no surprise to see precious metals performing so well. After all, U.S. government debt is spiraling out of control, the Federal Reserve is printing dollars like crazy, and demand from the emerging markets is causing a run on all kinds of natural resources. Inflation talk is everywhere, but it's unusual to see silver performing so much better than gold. To get a sense of just how unusual, take a look at the historical relationship between the two metals. When SLV was launched in 2006, the gold-silver ratio was about 47-1. You needed 47 ounces of silver to buy 1 ounce of gold. The ratio shot up to 83-1 at the height of the financial crisis because gold was considered less vulnerable to falling industrial demand. And over the next 2 years, the ratio never fell below 58-1. But now, it's tumbled all the way down to 33-1. The increase in the value of silver can be explained in several ways. Silver has many industrial uses in addition to its long-standing monetary role as the poor man's gold. Worldwide supplies haven't grown much, and demand for silver is healthy. Still, the current rally looks more than a little overdone. The availability of SLV and similar ETFs makes it easy for speculators to pile into this relatively small market, resulting in a price spike. In fact, last week, Barron's reported that the trading volume of SLV overtook the Spider S&P 500 ETF, which tracks the broadest gauge of the U.S. stock market. That just shouldn't happen, and it tells me that the silver rally is getting absurdly speculative. Of course, that doesn't mean it can't continue. Momentum can carry an ETF far higher or lower than most people think possible. Picking a top in a market like silver can be tough. So, I'm not about to predict a repeat of 1979 to 1980 when silver prices rose from $11 an ounce to nearly $50 and then collapsed. However, I do believe that the risk in SLV or anything else silver-related is unacceptably high right now. If you want to bet against silver, you can buy the ProShares Ultra Short Silver ETF, ticker symbol ZSL. But be very careful. That's a pretty risky trade too, especially since the 2 times daily leverage makes an already volatile market even crazier. The bottom line is that if you want to own a precious metals ETF, I think those that follow gold are a much better value than the ones that track silver. Gold is by no means a low-risk market, but compared to silver, it's an island of stability. For Money and Markets TV, I'm Ron Rowland. Thank you for watching.